All right, hi everyone. Thanks for joining me today. I'm going to give you a presentation about swing trading from naked to fully dressed, and it's going to be a purely educational presentation. I'm saying right now I'm not going to sell anything or promote anything specifically. Feel free, if you have any comments, to ask during the presentation, and I or Gil will answer. So a little bit about myself. My name is Yaniv Elbaz. I'm actually also a VP Global Operations at investing.com. I'm a trading mentality coach. Occasionally, I'm an avid technical analyst. Actually, I loved Wally's presentation. Very interesting. I enjoyed it a lot. And I've been trading since 2008, Forex, futures, stocks, day trading, also swing trading, scalping occasionally. So all of it together. This presentation today, I've been invited by the 5%ers to give this webinar, and I'm very happy to share it with their traders and with everyone else here. So thanks to the 5%ers for giving me the stage today. The 5%ers, by the way, for those who don't know it, is a funded trading and growth program that provides unique career enhancers for worldwide Forex traders, including an accelerated growth plan to boost capital levels and earn higher profits. So this webinar today will be composed of 4 parts. First of all, how to read and trade naked charts, supply and demand zones, price action. I'm sure most of you have heard about it. I'm just going to put an emphasis about what I'm looking at and the formations or the setups I'm looking at or paying attention to. Then we'll put on a shirt on the chart in the form of moving averages to look for better entry points. Then the chart will wear on pants as well to in the form of an oscillator to show you again more, even a higher probability entry setup, but also signs of weakness and exits. And then I'll discuss shortly your helmet, your risk management, your mentality rules. I think it's the most important part, trading mentality and risk management, but obviously we're here for trading strategies, so I'll keep it short. Technical analysis is a windsock, not a crystal ball. This is important to say. Like Wally, I very much believe in technical analysis. I love it, but you need to remember, and everything I'm going to show you, I've selected the best examples, but it's never like a 100% predictor. It's just an indicator. It's just giving you like a windsock. It's giving you the direction. It's giving you a sense of where the market might be going. It's giving you an edge to increase your chances and make you or give you a bit higher probability for profit. It doesn't make you, you will never know for sure where the market is going. It's not a crystal ball. So remember that all the time. Let's start with reading and trading naked charts to identify where the buyers and sellers are waiting, how to draw the significant supply and demand zones, and to use price action. First, I'll talk about how to read or what to look for on the charts. So obviously, we're going always from the higher time frames to the lower time frames. And if you're swing traders, you should be looking at the highest time frames, in this case, like the monthly, the weekly, the daily charts. Some may even look maybe on the yearly charts, but these are less relevant. And monthly charts are more than enough. If you're day trading on the daily charts, then of course you should look at the monthly and the weekly. If you're trading the 4-hour charts, you should look at the daily and the weekly. You can use the monthly as well. Look for zones from which big moves were initiated. These are the zones that are where the price reacts most strongly. So look for, it's very easy to see where prices started their big moves up or down. These are the big places where the buyers and sellers are waiting, and then draw these zones on the charts to see when the price is coming back to these zones on various time frames to look for the price action and to see how the price behaves around these zones. So price action, mostly candles such as engulfing, bullish or bearish, the Morobozu, or the doji candles, spinning tops, pin bars, these price action candles, how the price compresses or approaches these zones and compresses into the zones. It's sort of a distribution or accumulation because these big zones are used by the institutionals, by big investors and big traders. So they cannot initiate their trade immediately. They have to approach this zone by selling or buying gradually into the area of interest. Of course, once you marked or drawn all these supply and demand zones, also don't forget to mark major support and resistance areas. These can be horizontal trend lines or diagonal trend lines around highs and lows. So let's take a look at this monthly chart. In this case, the Russell 2000. It was actually, since this index is of 2,000 stocks and it's not tilted towards like very big stocks, as in the case of the NASDAQ or the S&P, where you have like the big five, Microsoft, Google, Amazon, etc. This is less, I would say it's more accurate or presenting more accurately the real economy. So you can see how the move, the big move of the coronavirus around the first few months of the year initiated from a huge supply zone on the monthly chart. This is where the supply zone was formed late in 2018, where we had the first drop during September, October, November, December. And then this supply zone was retested at the beginning of the year, and the big drop happened. The NASDAQ, of course, formed higher highs at the time, but the Russell 2000 was very technical here. You can see demand zones coming from in 2012, in 2016. So it's very easy to see where the big moves initiated, and from these entry points or start points, these demand zones were formed and later on retested. In between, like inside these big legs or big moves, you have obviously minor demand or supply zones. So for example, I gave just one example of this minor demand zone that was tested at the end of 2018. Okay, but it's not a very I mean, it's a big zone, but it's not a very strong one because it was in the middle of a move. So obviously there were other demand zones during this move also here. This demand zone, for example, didn't hold during the drop of 2018. This one did, but not this year. So this one was consumed. Who knows, if we experience another big leg down, who knows, maybe we'll retest the lows of 2012 or the demand zone of that, this lower demand zone. We'll have to wait and see. So far, the demand zone of 2016 held on, and it was a nice signal for buyers. And if we look at the weekly chart, now we start going down to the lower time frames, we can see how I marked the monthly supply zone here in blue. You can see on the weekly chart how the price started behaving around the supply zone or on lower time frames. Okay, so you can see that here it formed sort of a double top. Here it went up, retested the demand zone, again here in blue rectangle, and then went up. So, and here you can see, like I mentioned before, supply and support and resistance. In this case, it was a channel. So the top of the channel was resistance. It was retested here as support and then broke, almost retested here and retested again here. So again, a very technical index. And then if we go to the daily chart, where you can start looking for entry signals and start trading for swing traders who trade the daily charts, you can look for entries around the supplier demand zones with daily candles and price action. So for example, here, again, the monthly and the weekly supply zones are marked. So you can see here the price action in the form of doji candles or shooting stars or whatever, and the double top around the supply zone. Here, if you enter around these areas, put your stop loss above this entry point and go below, you have plenty of room to go down, but we'll discuss entry points in a minute. I'm still showing you just how to read the charts. So again, going down to the supply zone, going up, going back, retesting, sorry, the demand zone, going up and down, retesting the demand zone from the monthly chart, and then going up. Now these dashed blue rectangles, I'll show you on the 4-hour chart, these formed the minor supply and demand zones. So those of you who are not trading the daily charts, maybe are looking for smaller entries or shorter entries, not trading for weeks but trading for days, you can always trade the 4-hour chart. So you can see here on the 4-hour chart price action coming from the demand zone that we've discussed earlier, and here these supply and demand zones on the 4-hour chart are marked, so you can see the 4-hour chart forming a demand zone. Coming up again from this demand zone on the daily chart, the red dashed area. Here, an area of price action, a big bullish candle, retesting and coming up. Again, minor demand zone within the 4-hour chart with price action, reversal for continuation. Here, there was head and shoulders within the daily supply zone. These two candles on the daily chart are actually head and shoulders inside the supply zone. So a reversal pattern, price action here again coming from demand. So what I'm saying, look for the supply and demand zones, go to the level, to the time frame where you're comfortable, but look at the higher time frames and look for price action on the higher time frame as well as on the time frame you're trading to give a higher probability. By the way, today you can see this is from an hour ago. So the Russell 2000 was going more than 3% up. It didn't even reach the demand zone, but it kind of met this this connection point around here. You can see a very strong bullish candle coming up on the 4-hour chart. So lots of buyers are waiting around this area. And on the Dow Jones, it actually tested the demand zone on the 4-hour chart and came up. A beautiful price action engulfing candle. So again, a great example of coming from where the buyers are waiting. Go always with the buyers or the sellers. Just look left and see where, where they're telling you that they're waiting for you to enter, and just be patient and wait for them. So money is made by sitting, not trading. That means you have to wait and wait for the price to reach these zones, wait for the price action to be completed, wait for the chart or the market to tell you, okay, I'm ready now to initiate the move. I'm ready now. The trend is forming or the price action is validated, etc. Most of the time, as traders, we're sitting, waiting for the setup. And once we enter, we're sitting again, waiting for either the target to be met or for contradicting signs to tell us this is time to exit. All right, so how do you trade it? Find an established move or a trend that's been initiated on higher time frames, then look for price action on the time frame you're trading or the time frame above. For example, if you're trading the 4 hours, look for the 4 hours or daily, and if you're trading the daily, then look at the weekly as well. For continuation, wait for an established trend that you see on the higher time frame, and then enter at minor supply or demand zones on your lower time frame. We'll see in a minute. For reversal, open the trade once the price action has been confirmed. Okay, it's usually like the price is moving to the area of supply or demand, forming price action, and then reversing, turning around. And of course, you have to take into account risk management. So always set a technical stop loss. Don't set a stop loss too close because you're afraid of taking the risk, or too far because you don't want it to be hit. Set it where you think the chart will tell you that, you know, this is the place where you think the price is not going your way. And in this case, if you're using price action or supply and demand, you can always set the stop loss across the price action area or across the supply and demand, and see if the target is good enough with your risk reward ratio at the next zone, the supply or demand or the support and resistance, to make sure that you have enough room for the target to be hit relatively to your risk, the risk you're taking. Obviously, and I'll talk about it at the end, make sure you're comfortable with the risk you're taking. I'll explain later on. So let's talk about continuation, see some examples. So here, for example, I see that the trend on the daily chart is very clear. I see a demand zone forming. I see here another demand zone and the price testing the demand zone. So I know, okay, I have a clear trend of overall. Seems for now that the trend is going up. Then I'm looking for areas like minor supply and demand areas to go in after at least so far the chart is telling me that the trend is up. Again, you never, I mean, you can assume where the trend is weakening, but as long as it's not showing signs of weakness, you can always look for the minor supply and demand zones to enter with the trend. So here I'm looking for the minor demand zones because I'm going long with a long trend. I'm looking for demand zones on the 4-hour chart. So you can see already here a demand zone forming, a big candle up on the left side, going up and then coming down to the demand zone. Now, if I'm looking to go long, I say, okay, if I set my stop loss below the demand zone and I'm going long, how much room do I have? At least I can assume that at least towards this supply zone. And you can see, by the way, that it's been retested, the supply zone. So if I have a risk reward ratio which is sufficient, let's say 1 to 1.5, 1 to 2, I can take the trade. Again, it's all a game of probabilities. And here you can see a good risk reward ratio. Then the price is coming back, retesting this demand zone. Again, price action here, sort of a pin bar coming up. And also here, a bullish candle, an engulfing candle. But if you feel like it's too far away from the bottom of the demand zone or from your stop loss, you can either you take a smaller trade or you wait for it to give you, in this case it did, to give you another chance to go and set a smaller stop loss or a tighter stop loss. It goes up again, it crosses the previous high and retests it. So resistance turns to support, forming around here another demand zone, testing it, going up again. And so you can see how demand zones were formed along the trend. And if you're swing trading, you can always leave your trades running for a few hours, a few days. It's up to you to decide where you want to take the target, how much risk you're taking. But if the trend is strong on the daily chart, you can let it run and until you see signs of weakness and you say, or let's say you reach the weekend and you don't want to leave your trade over the weekend, you can always close it there. But you can see how like the very like smooth moves coming out of the demand zones, and the risk-reward ratio is very, very nice. Again, I drew here some trend lines that show also potential support or resistance lines, in this case diagonal, that also served as support, but I'm focusing here on the minor demand zones. So this is an example of how really naked charts, no indicators, nothing, just looking for the price to come back to the demand zones, give you price action, and let you calculate what the risk-reward ratio is and enter if all parameters are met. Then for reversal, like I said, you can look for areas where the price came back to strong demand, supply or demand zones, look for reversal patterns, and then start looking for places to go in. This is a monthly chart on the euro yen. So obviously I'm not saying you could have taken this huge monthly candle or this entire move, but once you see that a price has been initiated from a strong supply zone in this case, and you can see what a big move came out of this zone. Obviously, there are sellers waiting here. So now you're starting to look on lower time frames for short entries and for swing trading down. So on the weekly chart, again, not for trading, just for unless you're very, very patient and you have you know, you can stand long moves and counter moves and long stops. But basically, again, the weekly chart is just giving you signs of what to look for on the lower time frames. And you can see here reversal candles just below. This is the turquoise rectangle is this spinning top. So this is what I marked here. And right below here, this candle, you can see I marked this line sort of as a support line turning to resistance. And here, from this area where this big move initiated, there another supply zone has been formed right below the monthly supply zone. So we have a monthly supply zone, we have a weekly supply zone, we have reversal candles, and now on the daily chart, you can start looking for entry areas or entry points and entry signals, an evening star, a bearish engulfing candle. Again, the stop loss can be above these patterns, and your take profit, you can see the first target can be set around the demand zone that was formed across. So I can assume that coming out from a weekly, a monthly supply zone, it will at least make a significant move to meet the demand zone across on a daily chart. And you can see it made even much bigger moves, and there are other demand zones or supply zones, sorry, forming here. But I just gave an example of the area of the reversal signals on the weekly chart. So this is swing trading from the daily chart, nice moves. Again, there are plenty of opportunities and signs here. Also for long from demand zones, but this is counter trending, or I usually avoid these trades, even though it's completely valid. Again, patience, patience, patience. The market is a device for transferring money from the impatient to the patient. Let the market come to you. Let the market give you the best setups. Don't chase the market. Just wait patiently for the market to give you the best setups, and you will be rewarded. So this was naked charts, simply demand, supply and demand, no indicators, no big magic on the charts, simply the charts, price action, some candle patterns, candlestick patterns. But now let's put a shirt on the chart in the form of moving averages that mostly serve as dynamic support or resistance, especially when the momentum is strong and when you see a clear trend. Okay, obviously when there's no trend, the moving averages are just noise on the chart. So I usually use the exponential moving averages 9 and 21 when I trade or intraday trading. When I do intraday trading on futures or stocks, I use VWAP. Sometimes I put the EMA 50 as well on higher time frames. But again, 9 and 21 for strong trends are more than enough. My two favorite continuation setups. So first of all, to enter around the moving averages, just above or below them, depending on the trend, with a pin bar or a doji candle bouncing off the moving averages. And the second setup is entering at a breakout adjacent to the exponential moving average from the moving averages after the flag or pennant has been breached. So again, the stop loss, very simple to set. You set it across either the pin bar or the moving average. If you want to be on the safe side, you can set it across the longer moving average, in this case, the 21 EMA. If I'm taking reversal pattern, then I'm first waiting for the moving averages to, of course, cross each other, and also for the price to cross them and retest them, which then sort of turns into a continuation pattern. And I'll show you that the two setups for reversal, how the candles form around the moving averages for reversal. Let's start with continuation. First of all, with moving averages, no other special confluence of price of supported demand or supplier demand, or support and resistance. So, like I said, if I have a clear trend with moving averages, I'm waiting for, pin bars, or in this case, like a sort of a shooting star or a doji or a spinning top, candles that show me that the price is about to reverse and continue the momentum or the trend from the moving averages. Here is an example of a flag formation, and upon the flag breakout, there is a potential entry. Here, again, it's a potential entry just because of the previous high, and it's sort of a resistance area. I'm not sure I would take it because it's already showing some sort of signs of weakness, but it's also a potential entry, just closing below the EMA, the longer EMA, the 21. But obviously, the stronger the trend, the more moves you will get from the shorter moving average. Now, you can always add support and resistance lines or supply and demand, we'll see in a minute, to give you higher confidence in the confluence or the combination of supply and demand or support and resistance with moving averages and these candle formations or this price action gives you higher probability, okay? By the way, always take into account, like I said, the risk-reward ratio. So for example, here, let's say you want to go in and you want to place your stop loss here, but you see there's support here. So obviously around this area, the support and the risk-reward ratio is not good enough. And therefore, where the dashed lines, if the risk-reward ratio is not good enough, just skip the trade. Even though it looks like a valid setup, I would usually avoid it. More examples with moving averages and supply and demand or support and resistance can be found here. Lots of areas where the trend is very strong. You can see here on the left, there is nothing, at least in the near history. So support turning to resistance, flag breakout, flag, support and resistance, support turning to resistance here. Obviously, this is not a good place to enter because we see support. I wouldn't enter here just because of the support. The risk-reward ratio is not good. but I'm showing you how the price is compressing and then eventually breaking down this support area. At the end, this candle, this pin bar is coming all the way up. I would, if I were in a trade here, I would probably just close it. And you can see that a demand zone is forming, and then the buyers come in, test this demand zone, and start actually turning or reversing the trend into a long trend. And now we can see continuation with the demand zone, just like we said, but on the long side here, a pin bar. And again, strong buyers coming in, forming a demand zone. The demand zone is retested, and then again, shooting up from demand with the moving average, in this case, the 21 moving average. So confluence of signals gives you higher probability, more confidence in your trade. You can set your stop loss very clearly, and it's really, I like these setups, and they actually work not only for 4 hours or daily charts, but also for 15-minute and 1 hour, and even the 2-minute charts that I trade very often. For reversal, 2 setups, like I mentioned earlier. One, when the candle crosses both moving averages, and then the moving averages reverse and the price retests the moving averages, and then it sort of turns into the continuation setups we saw earlier, because now the trend has reversed. The second setup is when the price is starting to form like demand zones or supply zones above. You start seeing pressure of buyers, and then they first test the first moving average, like cross it, go sit on it or retest it, and then cross the second moving average, then the moving averages cross, and then you have a continuation of the counter trend. So let's see a few examples. For example, here, this is the second setup where we have another example of a demand zone forming, retesting. You can see here that even though the price crossed the moving averages, they didn't cross. And then when the price revisited the demand zone and crossed, retested the first moving average, crossed it, retested the second moving average, and then when the moving averages have already crossed, and around here you can go in. Here is an example of a pennant. Like I said earlier, I showed you flags. Here it's a pennant. Again, it's adjacent to the moving averages. Crossing, you can, since it's on the moving averages, you can take the breakout. You don't have to wait for the completion, because the completion can be very, very violent, very strong. Usually I just take the breakout just because I know there's already a trend. If I'm trading futures or anything that has volume, stocks, futures, then usually the volume here goes down and then continues going up as the trend continues. So this is a great example of continuation after the price had reversed. Here, another example, but here the reversal of the first, well, it's actually the first and the second types, because it's going up, going down again, but retesting and then crossing both moving averages with a big candle, retesting. And even if you didn't see the moving averages crossing or here, or didn't take this move, you can take it when the price revisits the moving averages. And you can see here also a demand zone around here. So you have another opportunity to go in. Now, everything I've showed you so far, everything I've shown you is examples of setups that worked. Obviously, there are sometimes setups don't work, or you have spikes that take you out. But remember, in this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10, and it's okay. If you have a good risk-reward ratio, you don't need to be right 9 times out of 10. It's more than enough to be 55% right, 60% right. it makes you a profitable and a consistent trader. So don't look for the holy grail. It doesn't exist. Putting on pants, let's talk about the lower or the bottom part of the chart. In this case, I'm using the stochastic oscillator. I'll show you why. RSI and MACD are great as well, maybe CCI, other indicators. There are tons of oscillators that you can add. I'm using sometimes the stochastic because it's pretty fast and it gives lots of nice signals. But for longer time frames or for longer highs and lows that are far apart, usually it's less adequate. Usually for highs and lows that are far apart, RSI and MACD are better. Still, stochastic is doing a great job at giving us signals of continuation and reversal. I'm using the 853, but you can use whatever is comfortable for you. So you can use divergences for continuation or reversal patterns for the entries to give you higher probability. Again, I'm not trading it only according to the oscillator. I'm looking for supply and demand or for support and resistance and for price action. So the stochastic is just an auxiliary indicator. It's just helping me to take a decision and see higher probability. Hidden divergences appear before continuation when the oscillator is overbought or oversold. For example, on the left here, you can see we have lower highs, but the oscillator is forming higher highs or going above 80, which is overbought. So higher highs on the oscillator, even though the price is forming lower highs. In this case, it's a downtrend. So when the oscillator is overbought, and you see usually the price reaching some supply or resistance area, it gives you a better signal for continuation, in this case down, because it's a downtrend. Okay, so here sort of a resistance area, but not a perfect one, just this maybe small candle. Here it's a very clear supply area or resistance area. The price is coming. You see hesitation here. The oscillator is overbought above 80, and then it goes down. So you can always set like a sort of an area where you enter below this consolidation zone. For entries, you can also use reversal or divergences, regular divergences that appear either bullish divergences or bearish divergences. In this case, I'm showing you bullish divergences, so lower lows, and then the price is forming higher lows on the oscillator again and again and again. But in this case, I'm not sure I would enter. Okay, actually it's forming here a demand zone, and you can see the price going up from this demand zone, and it actually formed a hidden divergence because we have higher lows and an oversold area. So this is for continuation. But here, for example, the price is going down, forming this doji, going up. And even if you don't enter here, because still the trend looks very bearish, once you cross, you have a divergence, you see, okay, the momentum is weakening, then you have buyers coming in, crossing this resistance, and then testing this support, which was resistance before. You can enter around here, stop below this candle, and then taking all the way up towards this previous supply zone from this area. And again, coming down to the support, hidden, a regular divergence, bullish divergence, forming here sort of price action in this with this spinning top and going up. So this is for entries. More examples of continuation, in this case, Facebook. So you can see around this area, which was support and resistance and support, whatever. And you can see this morning star, a reversal pattern. The price, even though it was higher than previous lows, it went oversold. Maybe not the best example, but again, if you see here an area of support and then reversal pattern, morning star, and oversold, it can give you an indication or a better sign or a signal to go in. You can see that the trend is up. It went down, retested this resistance, turning to support, retested it, forming this small candle sort of price action. The oscillator is oversold again, going up this time. Notice how when it went up to this previous resistance, okay, which turned to support, turning to resistance, okay, forming an evening star in a way, and it's already bought, okay, even though the price didn't form a higher high, it formed the very high overbought area on the oscillator. And again, with the combination of sort of support turning to resistance, it can give you an opportunity to go short. Apple, here is an example of continuation. Again, support, retested, overbought, even though the price didn't form a lower low here, a much higher low than previous, but it's already oversold. Going up, even if you don't go up or don't go long below the moving averages, you see how the moving averages are crossed. You can go above the moving averages when the price consolidates into the moving averages. You see here, by the way, that the price, even though it went below the moving averages, this area of demand held the price and it went back up again. Resistance turning to support. Again, the price went oversold here. And again, resistance turning to support. The price is sitting on the moving averages, almost oversold, but even if it's not oversold, look how, even though the low here is much higher than previous lows, it went much lower on the stochastic. So a hidden divergence for continuation in this case up. And again, going up, sitting on the moving averages, and you see here this buyer's pressure here, and going low, forming hidden divergence again, and continuing up. So this setup is very nice. Confluence of moving averages, support resistance, stochastic, all together, just giving good signs without much analysis. Okay, simple things. Just be aware of, look left and see the support and resistance areas. Even without having stochastic, even without having moving averages, pure support resistance or demand and supply and demand gives you awesome signals. The moving averages just give you more confirmation and better confidence in the trade. And also you can use the moving average as a trailing stop, especially when the trend is strong. So for reversal, we saw some bullish or bearish divergence. Again, you can see here the trend weakening. So it's giving you, if you're short, it's giving you an indication of, okay, I better start covering my short, maybe even looking for long. And you can see here divergence, bullish divergence on top of a demand zone already forming, and then crossing, retesting the moving averages, the same setup we discussed earlier, and then the reversal turning into continuation and continues upward. So an indication from the oscillator about reversal on top of the demand zone, moving average reversal, and then retest for continuation, a perfect setup. Same here, reversal, testing, continuing up, and see here how the price formed a small divergence, but on top of this support area. So again, if you're going short, at least it's telling you, be careful, something is happening here. Look left, look down, okay? And you can see that the price made a significant move up. Twitter, just as an example, on the daily chart for both continuation and reversal. So in this case, continuation, when it retested the supply zone and formed a much higher high, went overbought actually on the oscillator before going down. This is the weekly chart, and the daily chart is showing you where it happened, okay, around this resistance, previous resistance. These candles, these two weekly candles here are these daily candles here on the left, and then it revisited the resistance, and here actually you can see a nice thing, how we have a bearish divergence between these two peaks. So coming into supply, coming into resistance, forming a bullish, bearish engulfing candle, forming bearish divergence. So this is a nice setup for reversal. The target can be previous demand. You can see that this demand was broken. And even if you took your trade here and went long for this small price action, your stop loss is just below the zone. So it's not a big deal. Like I said, it's not a crystal ball, but many times, more than not, it will work for you. And with a proper risk-reward ratio and risk management, you will be profitable over time. A very nice example of continuation. So you can see that the weekly chart is showing sort of reversal here with this bearish, with this bullish divergence. And then on the daily chart, it's forming a demand zone. Again, wait, you don't need to take the move right away. Wait for the price to give you the confirmation. In this case, it's coming, revisiting the demand zone, price action in the form of a morning star, a doji candle. The price is oversold and going up. Okay, again, almost revisiting this demand zone. And even if not, it's fine. I mean, whatever you take, you take. You don't have to guess. You don't have to chase the market. Take the best signals you can. So just a couple of more examples of fully dressed charts, moving averages, demand, stochastic, support, resistance, whatever. So you can see here a demand zone, the price is sitting on it, and then crossing the moving averages, retesting, going very strongly up, very nice. And even if you didn't take it, it's giving you a chance to take the price right above the moving average and the previous resistance, and continues up. Obviously here we see weakening of the price, and then it's breaking down again. And like we said earlier, taking these candles just close to the moving averages and below, in this case below support. Okay, it was resistance, support, support again, broken, retested, and going down. Perfect setups. Really, just wait for these setups to tell you, take me. Okay. I see here there are, wait, I can't see the chat for some reason, so I don't know why, but I'll answer the questions, or maybe Gil can reply to you, because for some reason I can't see the chat as I'm sharing the screen. Again, another example here of reversal. In this case, the moving averages again didn't cross. There was a demand zone. This is crude oil for our chart. The demand zone is forming, going above the moving averages, retesting. And even if you didn't take this area, see how it's retesting this resistance, just sitting on the moving averages before going up. And you see how the price formed here a hidden divergence by forming a lower low on the oscillator, going oversold. Another example, I won't go over it, lots of examples. You can just review the recording and pause on this slide, because it has tons of examples of demand zones, coming back to demand, going oversold, going overbought, divergences, hidden and regular divergences. It's just and this is a weekly chart, by the way, on the DAX. So you have plenty of opportunities, and you don't need to chase the charts. Just let the markets give you the best opportunities. Remember, and this is the last part I'm going to discuss about risk management and trading mentality. Being wrong is acceptable. It's totally fine. You'll be wrong 3, 4, maybe even 5 times out of 10. But as long as your risk-reward ratio is good, as long as you have a good trading mentality and discipline, you will be profitable. Just test your edge, log in your trades. Being wrong is acceptable. Staying wrong by not setting a stop loss, by trying to, I don't know, wait for the market to turn around and let you out at break even, whatever. Staying wrong is totally unacceptable. This will be the part where you will never be consistent if you stay wrong. And if you don't use a stop loss, if you don't cut your losses or cut your losses short, then you know, like they say, traders who let their losses run eat like a bird and shit like an elephant. So you eat a little every time, and then comes the trade that takes out all your profits. Don't do it. So always use a stop loss. I've given you all the information on how to set your stop loss here across the price action candles or price action zones or demand and supply zones or the moving averages. You have no reason to not set a stop loss because these setups have high probability, and whenever it's not working, it's not working. Take the loss, move on to the next trade. Use technical levels, like I said, and then set your position size accordingly, according to the risk you're willing to take. Be sure you're completely comfortable with the risk. If you're comfortable with the risk, you will let the trade run. You will not move your stop loss. You will not avoid setting a stop loss because you're aware of the risk. You're accepting the risk. You're comfortable with the risk. Make sure before you enter the trade that you're comfortable with the risk. Think on a series of trades basis. Some trades work, some trades don't work. It's fine. Use a trading journal, and then you will see if your edge is working and what's working better and what's working less good. And then think on a series of trades basis. Don't put too much significance on any one trade. Remember to look left. Look where the buyers and the sellers are waiting. The big candles, especially supplier demand zones that are formed with engulfing candles, are the strongest zones. Use them for your benefit and wait for the price to retest them and then take the trade from them. Be patient. Don't chase the market. The good trades reveal themselves all the time. Just wait for them. Be patient. And once you enter and you've set your stop and your limit, your target, be patient. Let the trade move. Don't move your stop loss too fast. You've already accepted the risk. Now let the profit come to you. And when you leave trades overnight or over the weekend, take into account geopolitical events, economic events, company earnings, whatever. You saw what happened with crude oil. Over a weekend, it dropped 30%, and from there all the way to minus $40. You saw what happened with some currencies, or what happened with earnings just recently with Wirecard dropping to dropping from 100 euros to around €1 in a week, okay, filing bankruptcy. So earnings, if the trend is not in your favor, if the stock or whatever is showing overall weakness, don't try to be a gambler. Don't say, okay, I'm leaving it for the earnings because maybe from 100 it'll jump to 120 or 130. In this case, it went from 100 to 1. So a 99% loss, it's not worth it. Log your trades, use a trading journal. There are good trading journals out there, but use even a simple one. Just put on all your trades and even your emotions, your feelings, your reasons. Take screenshots when you enter the trade, when you exit the trade, a few hours or day after the trade, and then analyze it. On the weekends, make an assessment of how you're doing, what can be improved, what not, but don't jump from one system to another. Don't look for the Holy Grail. Be consistent. Your goal is to improve over time and to become consistent, not, especially when you don't have an edge yet that you can trust. Your goal is to become more consistent and to trust your edge, and then over time increase the position size and become profitable. But first, aim to improve, aim to become consistent, focus on the process. The money will follow. Don't look at the results. The professional traders don't look at the results, especially not during the trading day. They enjoy the process. They focus on the process. They look at the market. They read the market. They live the market. At the end of the day, they can look at their P&L. At the end of the week, they can look at their total P&L or their log, but focus on the process. Basically, this is it. If you have any questions, you can always go to the 5%ers website, thefivers.com. You can contact us via the contact us form. You can send an email to help@thefivers.com. If you want to set a short Zoom meeting with me, I don't know, 20 minutes. If you need help with your trading, with your setups, with your technical analysis, with your methodology, with your trading mentality, with your trading log, with your risk management. If you need help, you can always set a free 20-minute call with me. And if you need more than that, we can take it from there. So that's it. I hope you enjoyed it. Thank you very much for joining me today. And good luck. Enjoy the rest of the webinars. David and Anka, thank you very much for having me. And I always enjoy being here. And keep up the good work.